Well, it's that time of year again when the independent research firm Delbar unveils its annual report, Quantitative Analysis of Investor Behavior, where they measure the effects of investor decisions to buy, sell, and switch into and out of mutual funds over the short-term and long-term time frames. And guess what? Investors fail miserably. And odds are you're one of them. Yes, you. Stay tuned to find out the 3 biggest behaviors that are destroying your investment wealth and what to do about it.
Welcome to this episode of Plan Your Wealth with Purpose, Principles for Investing and Wealth Creation, with Wealth Creation's education and tax coach, Jim Fisher.
First, let me start out by saying Delbar uses the S&P 500 as a benchmark for comparison. And if you've seen my episode, Why This Investment Advisor Doesn't Care About the Market, you'll understand the S&P 500 is only 500 of the largest capitalized stocks and pretty much represents one asset class out of a minimum of 19. That said, Delbar shows that over a 30-year period, an equity or stock investor only achieved 3.7% return while the S&P earned 11, and over 7% difference. The 20-year period was better at 5.19 versus 9.85, and over 4% difference. A composite fund investor only earned 2.47% and 3.34% over a 30-year and 20-year period, respectively. To put it in layman's terms, that sucks. You suck as an investor, and your financial advisor probably sucks also. And here's why. When discussing investor behavior, it is helpful to first understand the specific thoughts and actions that lead to poor decision making. Investment behavior is not simply buying and selling at the wrong time. It is the psychological traps, triggers, and misconceptions that cause investors to act irrationally. That irrationality leads to buying and selling at the wrong time, which leads to underperformance. There are 9 distinct behaviors that tend to plague investors based on their personal experiences and unique personalities. Number 1, loss aversion, expecting to find high returns with low risk. Hey, we all want to hit the lottery. But when it comes to investing, there is no free lunch. We have evidence on a sliding scale that shows the maximum return expected for the level of risk taking. If you expect more than this, it's called speculating. If your advisor hasn't shared this with you, get a new advisor. Number 2, narrow framing, making decisions without considering all the implications. I think this pretty much goes with number 1. We see all the advertisements and articles about past performance and the next hot stock or fund to own without truly understanding investing and how markets work. Would a business embark on a business proposal without weighing all the known data and implications of its decision? No. So why do you when you invest? Number 3, anchoring, relating to the familiar experiences even when inappropriate. This is an emotional response. People don't like to change and tend to keep the devil they know versus the devil they don't know. This comes from the emotion of fear. Living in investment fear is no way to enjoy your life, create wealth, and to live your purpose. The good news is we can help. I have a process that helps put these emotional behavioral issues in check. It starts with about 30 minutes of education about your current investment portfolio and your current emotional investment state of mind. Then we follow it up with ongoing coaching. Next episode, I'll unveil more behavioral findings by Delbar. In the meantime, I suggest you head over to my website and request your free investor awareness guide to learn more and get started on your journey to investment peace of mind.
Thank you for watching this episode of Plan Your Wealth with Purpose with Jim Fisher. For more information, visit wealthcreations.com. Also, browse the other shows found right here at Toledo Biz TV Shows.